What happened to the Silicon Valley Bank? How did it go from being one of the largest lenders of tech companies to being completely seized by the regulators in a matter of 36 hours? Now guys, we all understand a bank has a very simple business model. It takes money from the customers and lends it out to the borrowers. It earns interests on the loans and pays interests on the deposits. The difference between the two is the bank's profit. But what happens when the bank's customers withdraw their money faster than the bank can repay them? What happens when the bank's investments lose their value because of changing market conditions? What happens when the bank is unable to meet its obligations?
Silicon Valley Bank is no more.
And in the last 24 hours, many founders, investors that I've talked to have been desperately trying to get their money out.
The collapse of Silicon Valley Bank is causing shockwaves across the entire business world.
Silicon Valley Bank becoming the second largest bank failure in U.S. history.
They just came out and told us that the bank is shut down.
You see, people, Silicon Valley Bank was not your ordinary bank. It was a bank that specialized in serving startups and tech companies in various sectors such as software, biotech, clean tech, and fintech. It was founded in 1983 by two former Bank of America managers who had a vision to create a bank that would understand and support the needs of entrepreneurs and innovators. They came up with the idea over a game of poker. Over the years, Silicon Valley Bank grew to become a powerhouse in the financial industry. It had more than $200 billion in assets and over 30 offices around the world. It provided loans, deposits, treasury management, foreign exchange, and other services to thousands of clients ranging from early-stage startups to established corporations. It also had close ties with the venture capitalists who invested in its clients. But what went wrong? How did a bank that was once a pioneer and a partner for innovation ended up being taken over by the US government? Well guys, the answer lies in two factors. A slowdown in venture capital funding in tech sector and rising interest rates. Silicon Valley Bank catered to firms in technology, life sciences, healthcare, venture capital, private equity, and premium wine markets. The bank provided loans, banking services, advisory services, and access to capital markets for thousands of tech companies at various stages of growth. Some of its notable clients included Airbnb, Stripe, Zoom, Shopify, Spotify, Netflix, Tesla, Coinbase, among many others. Now, Silicon Valley Bank also invested heavily in bonds issued by governments and corporations as part of its asset portfolio. These bonds are considered safe investments because they pay fixed interest rates over time. However, they also have a downside. Their value can fluctuate depending on market conditions. In late 2022 and early 2023, market conditions changed dramatically. The Federal Reserve raised interest rates several times to combat rising inflation caused by supply chain disruptions and pent-up demand after the COVID-19 pandemic. Higher interest rates meant the newer bonds issued by the governments and corporations paid higher yields than older bonds held by banks like the Silicon Valley Bank. This created a problem. Its bond portfolio lost value as investors preferred newer bonds with higher yields. Normally, this would not be an issue because banks hold bonds until they mature or sell them at a profit when interest rates fall again. But Silicon Valley Bank faced another challenge. Its customers started to withdraw their deposits. Why did this happen? Why did the tech companies need more cash? One reason was that some of its tech clients needed more cash to fund their operations amid a slowdown in venture capital funding caused by market unnecessity. According to PitchBook data, global venture capital funding fell by 9% from $300 billion US in 2021 to $273 billion US in 2022. Another reason was that some of its clients lost confidence in Silicon Valley Bank's financial stability after seeing its bond losses reported in public filings. As more customers withdrew their money from Silicon Valley Bank, the bank had to sell some of its bonds at loss to raise cash quickly. This created a vicious cycle. Selling bonds at a loss eroded the bank's capital base, the difference between its assets and liabilities, which made it harder for it to lend money or attract new deposits, which led to more withdrawals, which forced it to sell more bonds at a loss, and so on. Eventually, Silicon Valley Bank became effectively insolvent. It owed more money than it had or could raise. On March 10, 2023, after rumors of its financial troubles spread online, depositors rushed to withdraw their money from its branches and ATMs across the country. The bank experienced a classic run on the bank scenario. It ran out of cash before it could sell its assets or raise new funds. On March 12, 2023, after hours of negotiations with potential buyers failed, the US government stepped in to seize Silicon Valley Bank's assets under federal law. The US Federal Deposit Insurance Corporation, FDIC as we call it, took over as a receiver and transferred most of Silicon Valley Bank's operations to a newly created entity called New SVB LLC. The FDIC also announced that all depositors would be fully protected up to $250,000 US per account. But this isn't helpful because almost all startups had money way beyond this figure. Collapse of the Silicon Valley Bank is the second biggest bank failure in US history after the Washington Mutual Bank, which failed during the financial crisis of 2008. It sent shockwaves through the financial system as investors feared contagious effects on other banks and markets. Because it might be just a 4-decade-old bank, but in just these 4 decades, it was already the 16th largest bank in the United States. This has raised a lot of concerns about the role of banks in supporting entrepreneurs, managing risks, and being regulated and supervised. It also raises questions about how the banking sector affects its customers, employees, shareholders, creditors, communities, and the environment. Essentially, people are worried about what this means for the future of innovation and how banks can better support it while being responsible to their various stakeholders. Its repercussions can also be seen in the stock markets throughout the globe. Because as they say, when US sneezes, the world catches cold.